Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Have my good friend Tom Staub back with us because I'm going to learn a bunch of stuff and ask a bunch of questions about something I have never done. But before we do, let's welcome Tom to the show. How you doing, buddy?
Hey, how's it going, sir?
It's going great. So something I've become very comfortable with just in the last 24 hours is talking about the fact that one rental at a time, this channel, my story, is about helping people build wealth. Wealth comes from owning assets for a long time. And this really led me to reaching out to you because you are doing something that I have never done. I think it is outstanding. It's cool. I have 1,000 questions. And I thought we just should record it so I can go back and watch it later, if you don't mind.
Absolutely.
So I'm going to kind of lay out the picture, how I understand it. Please correct me where I'm wrong. But as I understand a conversation we had a couple of weeks ago, you're out in Texas. You are actively looking and actually have found some plots of land. I don't know, call it 50 to 100, 200 acres. So big plots of dirt. And your vision for that is to build housing. And we talked about building kind of lots of different housing types and on that. And I have no idea how you do that. How do you get the land? How do you do the debt? How do you get from construction to this? I mean, there's so many questions I have. So kind of lay it out for us.
Let me give you, let me introduce myself. Tom Staub, CEO of Red Oak. I'm also the managing partner at Viewpoint Engineering, which is our in-house engineering company. I'm on track to have 20 employees by the end of the year. Wow. And that's a big chunk of how this all works, right? So to date, we have about $400 million of projects in the portfolio, right? Okay. We primarily work in Austin, Texas, in the outer skirts of Austin, within 30 minutes to an hour. We have some stuff in Arizona, but Austin's really the hotbed right now. So we have our bread and butter is really a 60 to 100 acre piece of land, right? Okay. And for easy math, most of these projects have a density of about 4 to 5 lots or homes per acre.
Okay.
All right.
So I'm taking notes. So I'm just going to write 5. So
yeah. And again, I'll be transparent in terms of our costs and how we look at or how we underwrite deals. But so that's exactly napkin math in terms of density. Now, really important, sewer and septic is probably one of the biggest differentiators between all these deals. If you have access to sewer, you have high density, like I just mentioned. If you don't, at best, you'll get 1 lot per half acre, but typically it's 1 acre. All right. So that drives really the cost of land. Is there water? Is there sewer? How's the soil? Is it too flat? Is it too slopey? It has to be just about right. And basically, you have to talk to builders to figure out if you were to build homes, what would they be priced at? Okay. And the exit price of lots tends to be around 20% of a home price.
Interesting. Okay.
All right.
So let me just ask some questions there because I'm seriously taking notes. So again, at Red Oak, is your vision to secure land, get lots ready, and then you sell lots to builders? Or are you taking it from raw land all the way to end product and selling?
Great question. I just had an investor conference last week on this exact topic. There's really 4 main categories of land, I guess, buying, right? Okay. We operate in 3 of them, and really primarily 1. So there's essentially where you buy land and you just store it as an investment, which I don't recommend unless you have legacy wealth, kind of a trust, right? It's a great asset for your kids, but not great for income. And some might argue that against me, but so we don't really do that. There's ones where you buy it and you spend 12 months with engineers like our team, and you just entitle it, get it approved, what they call plat approved, and then you sell it to builders to do all the construction.
Okay. Right? So it's still raw land, but you got pretty drawings.
Yeah, that's right. So, and okay. Like for example, there's an anticipated rumor of Micron being announced here in the next 4 weeks. We already have projects in motion to be approved in the next 2 months. If that happens, we might not even do any construction. We might just sell it off to developers or builders or what have you. So that's about 10% of our portfolio. Okay. About 80% of our portfolio is in what we call improved lots, where you buy land, do the entitlements, and the approvals, and then you do construction on the utilities. So the dirt, the grading, the roads, the water, the sewer, and you build those lots for builders to build on.
All right, so let me say it. So again, so raw land bank, don't do that. Raw land, pretty pictures, 10%. Raw land, pretty pictures, now infrastructure.
That's right.
Okay.
Yeah. And by the way, that's where a lot of developers, and given the market where it's going, we're getting a little worried about how far we want to go down into that process. Entitlements is a pretty safe play. When you get into construction, that does take 6 to 8 months per phase, and we can deliver 100 to 150 lots per phase. Okay. So, and this is a big reason why builders are so behind. They can't find these lots, right? And back in the 08 crash, they were burned by having too many unimproved lots on the books.
Yeah. I've been doing this a long time. That was really what got people is kind of from 04 to 06, more and more publicly traded companies and private companies, they wanted to be land banks. That's what they were doing.
Yep.
And when suddenly you can't sell any homes, that land bank becomes a big dead anvil, right?
That's right. That's right.
Okay.
Yeah. Then the third piece, which we're slowly expanding into, whether it be builder rent models or what now will be ground up multifamily or townhomes, which is our bread and butter as well, is we'll take about a third of the property and we'll allocate it towards our fully ground up development. And this is what we did in Arizona initially. So again, buying land, entitlements, horizontal construction, and then the vertical.
Got it.
Right. Now, in this process, the biggest margins are on the vertical, but it's also the riskiest and by far the most amount of headaches.
Yeah. And also longest, obviously.
Yeah.
Okay. So let's just talk about 100 acres because it's a nice round number. You find 100 acres somewhere in the outskirts of Austin, negotiate a price that works. Are we talking, I need a number, right? So we're talking about 100. Are we talking 10 grand an acre, 50 grand? I have no idea.
So it all depends, right? Let's assume, it's good land, everything's great. There's minimal flood zone. You have sewer access. Everything's great, right?
Okay.
We'll assume an average price point of like $400,000 a home.
A home.
A home. Okay.
So that's so that's $2 million an acre. 5 times 4.
Well, yeah. So assuming that we were building homes, but let's assume that if we were to do all the lots, those homes that would be built on there will be at that price point.
Oh, I see what you're doing.
Okay.
You're saying 20% of that's the land.
So we'll assume that we could sell it for $80,000 a lot.
Got it. Okay.
Now, again, here's a lot of numbers here. Right now in this market with commodities, and they're coming down, the cost to build out a lot today, it's around $28,000 a lot.
Okay.
So now we have some math here, right? 80,000 for the extra price on the lot. Let's
minus
do math for 30,000.
Right.
So the remaining cost is $50,000.
Got it.
Now we don't make that much. Our margins are around 20%.
Okay.
So we're buying it at around $50,000, $80,000 per acre.
Okay. So let's just say 50,000 an acre. You're buying 100 acre. Am I doing that? Is that $5 million? $5
to $8 million is around our average price point.
Okay. So Red Oak identifies the property, negotiates $50,000. I've never done this, so these might be really stupid. Does Red Oak just have an equity line or something where you go out and you stroke?
So a lot of my job is out there meeting family offices, meeting funds, talking to debt people, talking to Chinese money, talking to money from Australia, whatever it is, right? That's what I do most of my day. We have many debt partners that come in and fund about 2/3 of the deal.
Okay.
At interest rates that I won't mention, but they're not great.
Yeah.
No, they're not credit card terrible, but they're not bank loan great. So
no, of course.
Yeah. 2 years terms on that. Yeah. And then we come in with about 35% equity plus 24 months of cash burn.
Okay. But again, right, you're coming in for debt. It's secured against land. It has no income. It's secured with a hope and a dream. So you would think the money would be expensive. So you have 60, I'll call it round number. Let's say 70% debt. You do have 30% equity from Red Oak, right? Your capital in.
Yep.
You also have, it sounds like you put away the payments. So that's escrowed or whatever it's called. Now you get busy, right? There's fees and costs because you're going to get it to the pretty picture now. You said that's usually 6 to 8 months.
So entitlements, back in the day in Texas, it used to be 8 months. Every county's backlogged. Okay. So we're looking at 12 to 15 months for most of our entitlements.
Okay. So you're 12 to 15 months. You get to the end. Let's just call it 18 months. For most of your stuff, have an exit because that's the point where you're going to sell.
That's right.
Right. So when do you start talking to the buyers? Do you have to wait till the entitlement's done or when does that happen?
Great question. So, it depends on who you ask. So, I will tell you on my initial deals, I was scared of the exit. So I went out and rushed to negotiations, locked in all the prices. A lot of prices have just skyrocketed.
Yeah.
In primary cities, Raleigh,
Sure.
Durham, Charlotte, Denver, Phoenix, Austin, Dallas, it's bananas. And, I have learned that well, one, before we even close on the deal, I'm already talking to builders. What would you pay for these lots, right? That helps us underwrite. Now, I will lock up a chunk of those lots, about a third, within the first 90 days of close. Okay. But it's a fine balance of trying to figure out the market. If it's going to go up, is it going to stay flat or down? Right. And so
Right.
depending on that, we'll either lock in all the contracts up front, or we'll slow play and assume some sort of appreciation. So it's really tricky.
Interesting.
And that's why we have a full-time accounting team that's tracking this stuff all day long.
So again, let's just play with this 100 acres, right? So so the escrow money to your land, to people that are the debt, are they getting that monthly, quarterly, or do they get that up front?
Depends. Yeah, I mean, most of our debt parties want it each month. So
Okay, that's fine.
I will tell you, I have more than $250,000 of debt service per month.
Yeah, and I would imagine that, right? That may, because they're coming in for debt for payments, right? That's income for them, so that makes sense to me.
Yeah.
Now, at the exit, do they just get paid off, or do they have some equity position where they get some preference return?
Yeah, great. All great questions. So we actually, again, this is where it kind of comes into strategy, assuming that we'll do the horizontal improvements.
Okay.
About 9 months into the entitlements, we go to our private debt parties or banks and say, hey, banks or private debt party, we want to do construction. And they say, great, what's it going to cost? $10 million. We'll give you $6 million of that 10 million. We say, fantastic. They also will pay off the hard money that came in.
Yeah. So this is where I wanted to get. So you get to some point. Again, construction loans is something you can get from banks, right? So the debt is cheaper. They will come in and pay off the first set of private investors or hard money. So and that's just interest. They're happy. They got their debt back. They had 18 months of payments. They're good. Now a construction loan comes in. That's more traditional financing. So your rates are much, much lower at that point.
Depends. Yeah. I mean, I don't like to use recourse bank loans. I mean, they are 5-6%, but if you use family funds and family offices, your 10% hard money goes to 8%. So it's not a big savings. And by the way, you're still paying those origination fees.
Yeah. You pay up again. Yeah.
Yeah. So it's really about getting more capital. Now, here's the thing. We assume the worst case. Let's say all construction financing goes belly up. No one wants to lend. We still have to be able to sell entitled lots in that scenario and make money.
Yeah. Okay. Wow. So that's why.
So here's one thing that I think you'll like. Now, I said 6 million of 10 million, right? Well, where does the other $4 million come from?
Yeah.
So here's the beauty of this. Right now in this market, and we think for some time, there's such a shortage of supply. Roughly, we're at 40% of the total 100 where we need to be on supply, that builders put up 15% equity up front.
Interesting.
Of the exit price. Now that exit price.
Has margin.
Yeah. Right. So that 15% usually is like 45% of the construction loan.
Now it makes sense.
Yeah. So basically our biggest hurdle is getting the debt up front, having a good underwriting process, and coming to the table with initial equity that's enough to carry us through the entire OPEX, entitlements, interest payments, plus additional 9 months, the just in case scenario. If we can get that equity and that debt, I mean, we have to be pretty dumb to screw up at that point.
So that makes sense to me. So that's why you spend most of your time up front is raising money for that initial, I don't know, call it round, or I don't know what the right word is.
I would say, 3 big categories: raising money naturally, getting investors comfortable with the vision of this. 2, my engineering team, and this is really why we brought them in-house. I need to know within 30 days what the risk is of that project. I want to know geotech soils. I want to know how much lime is in the soil. Is there flooding risk? What's the hurdle for grading and roads? How are the cities? Are they pro-build? Are they not? Are they painted butt to work with?
Yeah.
All those things. That's a big risk. And if we get that figured out, then it's a matter of, will builders buy at a price? And yes. Okay. Then we go raise capital. Yeah.
So I'm guessing you only are playing. I don't know. Playing's the wrong word. You're only talking to accredited investors. You're talking family offices, stuff like that.
Yeah. Well, but I started from like the grassroots of real estate, right? Flipping way back. And in that time, I brought with me retail investors, as they're called, people who write checks of 40 grand or higher.
Mm.
So we still cater to those people, and we want them in our deals because we don't want the institutions to make all the money. These are going well, that they're paying very attractive returns. And again, me coming from my beginnings, I want to always give that option to the people who are trying to grow their own portfolio. So it's a mix.
Interesting. I did not expect that. So if somebody wanted to reach out and get into the details of rates and projects and stuff like that, where do you send them? I'm just curious.
Yeah, just go to the website, redoakvc.com, and email us. And you'll see our team there, and happy to send other recordings that we've done recently to investors. And we have a in-house economist from Penn that can provide you reports and all sort of metrics to make you feel comfortable or not, depending.
Yeah. This is interesting. So again, you're in Texas, outskirts of Austin, right? Texas, Florida, a lot of migration coming. Makes sense. Yeah. You're not doing, again, one of the things I didn't know is you're not taking maximum risk, right? You're not trying to take it from raw land all the way to this full community, right? You basically get it to a point where a builder comes in and takes that last chunk of risk.
Yeah, I mean, it depends, right? These build to rent investors, and I'm getting a lot of attention from them right now. In those structures, and again, I'll just be transparent, I do a cost plus model. So I'll do it, but cost plus 20. So I'm going to protect my risk 100%.
Yeah, you're locked in, you're done.
Yeah, I don't, so for me, that's gravy, right? In those deals, I'll do it. And we're talking to some people out in New York right now for that.
That's interesting because I actually think build for rent is going to be a big deal because I think owner occupant buying is going to go down. I talked about transactions falling 25%.
Yep.
Wall Street still sees single families as the best risk adjusted return. And with a lot less homeowners, I think builders are going to starve to sell. So maybe builders turn to build for rent as an easier exit. Yeah.
I mean, people still need shelter. It's either rentals or the owners, or they own it, right? So, it's fascinating times. Again, I am up all the time with anxiety, trying to figure out what's happening next. And
yeah, I'm sure $400 million that'll keep you up at night.
Yeah, it'll keep me up. So I spend my weeks. This Wednesday, I'm inviting every builder, every VP of every builder that you can think of: D.R. Horton, Lennar, KB, Castle Rock, Braun. They're all coming to a happy hour. And in those situations where I learn more than anyone else, right? Yeah. They're telling me what they're seeing in their pipeline. They're telling me where there's weakness, where there's not. And I will tell you, somewhat anecdotally, but from in the grapevine, there are the high production builders that are building in the 250 to 350 range are seeing some pull up on demand, right? Now, who's not, and this is interesting, is luxury is doing fantastic. I'm calling it the KShape Summer. What we're seeing is, again, the first time home buyer, the affordable homes are getting crushed. This is why we will see transactions fall and median price rise. Yep. The rich always have money. That's right. The rich aren't impacted. Yeah. And we've lost the low end, right? Yeah. Somebody who qualified for 3% is not qualified at 6%. It's just math. Yeah. That's and right. That first time home buyer, affordable home, whatever the right vernacular is, they got smashed. Interest rates have only got up this fast one other time. This happened in 100 days. Yeah. Which, by the way, so what this is going to do, which is counter to what we need, it's going to push builders into the mid-grade product, 450 and above, or build for rent. Oh, exactly right. So, and it's going to pull away more affordable housing. Exactly. So it's just going to make the situation worse. Oh, geez. Yeah, it's bad. So. Yeah. Now, I will tell you, though, there's light at the end of the tunnel. So as this is all happening, naturally, demand's coming down on commodities. Yeah. So builders have the ability to reduce price in these segments, and they'll make it up in the margins because commodities are coming down. So it's kind of going to, how it went up in tandem? Well, it's like that in tandem. No, I agree. Yeah, this is a wild time. I've said it, and I'll say it 100 more times. The Fed broke housing. The last 2 years, All In podcast called it fueled by cocaine and Red Bull. I agree. I think we've got 2 years of a hangover. Yeah. And then the market will work itself out. But the next 2 years, affordable homes, first time home buyers, it's tough. Yeah. Rates at 6, home prices up. It's tough. We need wage inflation. We need to get through this. Yeah, it is fascinating times. It's very complex out there, as you know. And again, and that's why we're not, there's a lot of dumb money chasing these deals too. And that's a big risk in this, is that the more that the money flows into these kind of projects, again, Austin's on everyone's roadmap to some extent. You're just seeing bad underwriting, and I won't touch certain communities where I see a lot of flooding happening in terms of the sharks. And so we're only picking deals that have extreme margins. We never buy an all market deal. It's all off market. We have an in-house team dedicated to finding those deals. And it's, and our pipeline's not enormous, but in my opinion, they're safe deals, right? We have we have a scenario under underwriting that assumes a 20% crash, and only in the scenarios that we still make money in those crashes do we actually buy. So
that's cool. Well, hey, if somebody wanted to reach out and just ask more details about upfront stuff, again, where do you want them to go?
Absolutely. Yeah. redoakvc.com.
Awesome, man. Well, thank you for educating me on this. I didn't know any of this. I've never even built anything. I'm trying to build a freaking ADU, and I'm getting to run around. I couldn't imagine trying to build housing on 100 acres, but it was fun to talk about. I appreciate it.
I'm losing my hair day by day. So.
All right, man. Take care of yourself. Thanks.
Thanks.